What happens when electricity is worth less than nothing? It sounds impossible, but it happens regularly. Electricity prices in Europe have gone negative over 1,000 times in the last 5 years. To understand why, you need to understand how energy trading actually works. Let's start with a simpler example from commodities. Imagine a wheat farmer. They plant in spring, harvest in December. They have no idea what the price will be. Now imagine a bakery chain. They need to buy that wheat in December. They don't know the price either. Both are exposed to the same thing, price uncertainty. If prices crash, the farmer can't cover costs. If prices spike, the bakery's margins disappear. Both lying awake at night, worrying about the same number. So what do? They agree on a price today, £200 per tonne for delivery in December. That's a forward contract. Come December, the spot price is £250. The bakery saves £50 on every tonne. The farmer could have earned more, but they knew their revenue 6 months ago. They could plan, hire, service their loans. Now flip it. The spot price drops to £150. The farmer still gets £200. The bakery overpaid, but their budget still works. They signed fixed-price contracts with supermarkets months ago. Neither side is trying to win. Both are buying certainty. And that, at its core, is what trading is for. So how does this work with real energy assets? A wind farm will generate 50 gigawatt hours next quarter. At today's forward price of £80 per megawatt hour, that's $4 million in revenue. But what if a mild winter pushes prices down to 50? Revenue drops to $2.5 million, below operating costs. So the wind farm sells power futures today, locking in £80. If spot falls to 50, they lose on the physical sale, but gain on the futures. Total revenue, $4 million, exactly as planned. This is hedging. You take a financial position that offsets your physical risk. It's not about making money on the trade, it's about removing uncertainty. And that matters because banks lend against predictable cash flows, not volatile ones. A hedged wind farm can finance its next project. An unhedged one is a liability on the balance sheet. So far, this could be wheat, copper, oil. What makes energy different? Think of the electricity grid as a lake with no dam. Power flows in from wind farms, solar panels, gas plants. Power flows out to homes, factories, data centers. Supply must equal demand, every single second. There is no warehouse. You can't stack electricity on a shelf and sell it next week. A cloud passes over a solar farm, output drops by half instantly. A gas plant trips. Suddenly there's a gap, and the price to fill it can spike to £1,000 per megawatt hour. And when there's too much supply? When wind is blowing hard and demand is low, prices go negative. Generators pay to stay connected. That's the world energy traders operate in. So what does an energy trader actually do all day? Morning, you review your positions. What have you already sold for today and tomorrow? Where are the gaps? What's the weather forecast doing to your generation output? 10 a.m. The day-ahead auction closes. You've submitted bids and offers for every hour of tomorrow. The exchange publishes clearing prices. You now know your revenue for tomorrow. Midday. Gas prices are moving. You adjust your hedges. Afternoon. You're in the intraday market. Continuous trading. Your wind forecast was wrong by 12%. You're buying power to cover the shortfall before the system operator charges you penalty rates. End of day. Reconciliation. Does your P&L match what the exchange says you traded? It should. Often, it doesn't. Energy isn't traded in just one market. There's a whole stack of revenue streams, and the desks that access all of them earn dramatically more than those that don't. The day-ahead market is the baseline. Sell tomorrow's power today. On its own, that's roughly £30,000 per megawatt per year. Intraday, adjust your position as forecasts change. The balancing mechanism, the grid operator pays a premium because it's an emergency fix, and emergencies are expensive. Ancillary services, batteries respond in milliseconds to stabilize frequency. The capacity market, you get paid just for being available. Stack them all together and you're looking at $70,000 per megawatt per year. 1 megawatt powers about 1,000 homes. A 100 megawatt portfolio accessing the full stack, that's $7 million a year. So why does all of this matter right now? Gas prices have doubled. The balancing mechanism is printing £1,500 per megawatt hour. Day-ahead spreads are the widest in 2 years. Battery storage deployment is accelerating across Europe, but the revenue is compressing in the markets that are easiest to access. The money is moving to the complex end of the stack, balancing, ancillary, dynamic services. The desks that can access the full stack safely with proper controls will thrive. The ones trading day ahead on spreadsheets will slowly bleed. Trading exists to transfer risk. Energy makes it uniquely complex. Understanding how these markets connect is the foundation everything else is built on. This video is part of a growing library of guides Jordan has written, covering everything from physical energy fundamentals and forward curves to position management, mark-to-market P&L, and BESS operational readiness. One senior software engineer at an energy trading company called them incredibly insightful, easy to read and understand. A product manager at EDF said he wished he'd had them during his PhD. The full guide library is available to members of Jordan's Skool community and to students on his energy trading bootcamps. Links are in the description. Subscribe to this channel. More videos like this one are on the way.